I want to thank everybody for joining us for this webinar on student loans, a very important and confusing topic right now. My name is Nancy Neerman. I'm the Assistant Director of the Education Debt Consumer Assistance Program, or EDCAP. I'm here with my colleague, Jenna Stanley. Just a few housekeeping items before we start the presentation. During the presentation, please keep yourselves on mute. If you have questions during the course of the presentation, you can type them into the Q&A, not the chat. I think you don't have access to the chat. So you can type them into the Q&A, and Jenna is going to be behind the scenes answering those questions. So if you have any questions on topics that we're discussing or any other student loan issues, you can just type them into the chat. We'll break periodically to kind of review some of those questions so that everybody gets the benefit of the answers. And then at the end, we'll also give everybody a last chance to ask any lingering questions. So with that, I am going to share my screen. And Jenna, if you can just confirm that we can see the screen.
Yes, I can see it.
Okay. And I'm just going to turn my camera off. I can figure out how to do that. Okay. So today's presentation, we've got a packed agenda. We're going to talk a little bit about EDCAP, the program that we work for. We're going to discuss longer-term strategies for tackling your student debt. We're going to talk about the legal challenges. I'm sure most of you are aware of the fact that there are some legal challenges against the SAVE plan. So we're going to talk about that and how that kind of fits into the current picture. We're going to go over your repayment options, forgiveness, cancellation, and discharge. A couple of words about the IDR Account Adjustment, which was a one-time account revision that's going to bring people closer to forgiveness. Fresh Start, which is a temporary program for defaulted borrowers, which is going to end soon, and then just a quick word on private loans. So to get started, a little bit about EDCAP. We are a program of a nonprofit organization called Community Service Society of New York, or CSS. CSS has been around for about 180 some odd years. EDCAP was actually created in 2019 specifically to address the student debt crisis. It's a national crisis. About 40 to 45 million borrowers nationally have about $1.7 trillion worth of student loan debt. That's the second largest consumer debt after mortgages. And in New York State alone, there were about 2.5 million borrowers with about $100 billion worth of debt. So the program was created to address this issue because A, it's very large, and B, because the student loan system happens to be extremely complicated and difficult to navigate. So some of the things that we will do, and we are, by the way, a state funded service, so we are free to anybody that comes and asks for our services, and we offer free webinars like this and also free one-on-one consultations. So at the end of this presentation, if you feel that you need help on an individual basis, you can contact us to schedule one of those one-on-ones with one of our counselors. And some of the things that we will do for you is help you determine your best student loan options, repayment options. We can help you access forgiveness, cancellation, and discharge programs. We can help you apply for consolidation. This is something we've done a lot of in the last couple of years. Deferments, forbearances. We'll also act as your advocate if you're having some kind of a dispute with your servicer or lender. So we'll hop on the phone until that dispute is resolved. We can help you get out of default or prevent you from going into default so that you don't have to be subjected to involuntary collections. And then while most of what we do deals with people who already have loans, we are increasingly reaching out to folks who are thinking about going back to school or going to school for the first time, or maybe looking to fund a child's education, to discuss how to fund higher education. So we can talk to you about financial aid offers and how to make a hopefully an affordable plan for going to college with minimum amounts of debt. I also want to mention that EDCAP has a network of partner organizations around the state. So there are 11 partner organizations that basically do what EDCAP does. EDCAP is based in New York City. We have organizations that are based all around the state. You can see it here on the map. Long Island, Westchester, upstate, and places like Rochester, Syracuse, Buffalo. And also the capital region. So we cover much of the state. Of course, EDCAP can talk to anybody anywhere in the state, but if you want personal, individual attention from somebody locally, you can contact one of our partner organizations. So I want to talk about strategies for tackling debt. So very often when clients come to schedule a meeting with us, they want to talk about something, their immediate needs, which is understandable, of course, if they maybe can't afford the repayment plan that they're in, or they're about to go into default, or they need to get out of default. That's something, of course, we're going to address that and make sure that they get back on track and that their loans remain in good standing. But one of the things that we always want to leave our clients with when they have a meeting with us is a longer term strategy for tackling the debt. Because at the end of the day, everybody's goal is to eliminate this debt and eliminate it as quickly as possible and with the, as the minimum amount of payments that they have to make. So what we found with working with clients for the last 5 years and many thousands of client meetings that we've done is that everybody pretty much falls into one of these 3 buckets when it comes to strategy. So the first bucket would be pay your debt in full as quickly as possible. And very often, when people take on debt for the first time, that is their understanding of what it means to enter into a debt obligation. Because after all, you are signing a contract that you are going to pay the loans back. But you'll see in a minute that within the federal system, there are different ways to approach this. But the pay the debt back in full as quickly as possible is really going to be best suited for borrowers who have high incomes relative to their debt balances. So it's going to allow them to maybe make a lump sum payment or pay more than the required amount, regardless of the repayment plan, so that they pay the debt down as quickly as possible. If this is your strategy, you want to go as aggressive as possible. So make as higher monthly payments if you can, make lump sum payments, because when you do that, you're going to pay the debt off faster and you will save money overall because you'll be paying less interest. So that's bucket number 1. Bucket number 2 is frankly where probably the majority of our clients lay. And that is that there is a very viable strategy within the federal student loan system that says that if you are pursuing a forgiveness program, the idea is to make the minimum required payment until such time as you get that forgiveness. So this is going to be for people who have high loan balances, low to moderate incomes. They may be pursuing certain forgiveness programs like public service loan forgiveness or income-driven repayment forgiveness, which allows them to pay for a set amount of time after which the balances are forgiven. If that's your goal, if this is your strategy, then you don't want to be making extra payments on your loans. And the way I always kind of ask people to kind of think about this is you look at the amount of debt that you've got, and let's say you have $100,000 worth of debt, but you're a teacher and you're earning $55,000 or $60,000 a year. If you're eligible for something like public service loan forgiveness, which means you could get the loans forgiven in 10 years, you say to yourself, is there any chance that I can pay this debt off in full before I can get forgiveness? And if you've got $100,000 worth of debt and you're making $50,000 to $60,000 a year, the chances of you paying that entire debt off in 10 years is probably relatively slim, in which case you're going to want to make this minimum required payment until you get your forgiveness. So in that case, there's no point in making extra payments on your loans. And then the final strategy, which sounds a little depressing, but we have it here for a reason, is to pay the minimum required until death do you part. And we put this on here because unlike most consumer debt, federal student loan debt, the forgiven balances are dischargeable in death. So with other consumer debt, if the primary borrower dies before the loan is paid off, then the obligation to pay that debt off passes to their estate, and then would eventually maybe pass to their beneficiaries, their decedents, their loved ones. That's not the case in the federal student loan system. If you, as the primary borrower, die, then the rest of the debt is dischargeable upon your death. It does not accrue to your loved ones. So for older borrowers, people that maybe took out loans late in life, or maybe took out loans for their kids to go to school, you may be faced with a situation where you're going to have to pay these loans for 20 or 30 years. But if you're 50 or 60 or 70, that could well mean that you're paying for the rest of your life. The strategy really is to just find the most affordable payment plan that you can, make those payments, and understand that when you pass, the burden is not going to be passed down to your loved ones. Okay. I want to talk now about I want to say a few words about the legal challenges that no doubt most of you are aware of at this point. So back in April, two lawsuits led by two different states, Kansas and Missouri, were filed challenging the SAVE plan. The SAVE plan, I think as most of you know, was the most recent income-driven repayment plan offered by the Department of Education late last year, when loans went back into repayment after the 3.5-year-long payment pause. It offers some very generous terms and options, and as a result, these states are basically challenging whether or not the SAVE plan is legal. There's a whole bunch of things that happened between April and July, but ultimately what happened is in the middle of July, a federal appeals court blocked the Department of Education from enrolling any borrowers in the SAVE plan or through offering forgiveness through that plan until these legal issues are resolved. In addition, the Department of Education asked the Supreme Court to intervene to allow the Department of Education to implement aspects of the plan while the court cases were being decided, but the Supreme Court refused. So what this means is that basically it's kind of caused the Department of Education to put the SAVE plan and some related IDR regulations kind of on pause until all of this gets resolved. And this could take many months. We don't really know how long it's going to take. So what's happened is, as a result, is that if you were enrolled in the SAVE plan when this happened, so the injunction took place on July 18th. If you were enrolled in the SAVE plan at that time, you were automatically placed in a non-interest bearing forbearance. So time spent in that forbearance is not going to qualify for forgiveness. We're going to talk a little bit more about that later, about if you're pursuing PSLF, and you're close to getting it, some strategies that you might take. But anybody that's trying to enroll in the SAVE plan, those applications aren't going to be processed until the legal issues are resolved. Other sort of byproducts of the legal challenges is that the online IDR and loan consolidation applications are not available. You can still submit paper applications for, actually, I just realized that it's paper applications for some of the IDR plans. It's not all four. I'll explain that later. But you have to expect long delays in processing at this point. And then the court ruling also affects other features of the IDR system. So how the system treats retroactive credit when you're consolidating loans for some forgiveness programs, which IDR plans are available. There are a whole kind of range of regulations that are also linked to these court challenges. So we understand that this is actually quite a challenging time right now for people to be managing their student debt. There's a lot of uncertainty in the system. But we'll try to help you navigate through it as best as we can until we come to a final resolution. Potential outcomes, well, the best case scenario is that the plaintiffs of these cases lose, and all features of SAVE and the related regulations are become available again to borrowers. So that includes reduced payments for borrowers that have any undergraduate school loans, a shortened path to forgiveness through the SAVE program if your loan balances were low, more periods of forbearance and deferment that count towards IDR forgiveness, and then the issue of when you consolidate loans that you don't lose any retroactive credit that you might have accumulated towards forgiveness programs. Worst case scenario is the opposite, that the court rules to strike down the SAVE plan and all its related regulations. At that point, our best guess is that the income-driven repayment program reverts to the pre-SAVE rules. So for any of you that might have been in the old revised pay-as-you-earn plan, which was the predecessor of SAVE, you would most likely be transitioned back into that if you're currently in SAVE. And for most borrowers, that means eventually that payments are probably going to increase across the board. And then borrowers that are consolidating direct or FFELP loans for IDR forgiveness, not PSLF, we're going to talk about that later. The payment count, forgiveness payment count would reset to 0 once you consolidate. The middle ground, which frankly at this point would be probably a good outcome if it happened, is that the court would allow some features of the SAVE plan to move forward, but eliminate others. Some of the features that we think would probably not survive that kind of a parsed outcome would be things like lower payments for borrowers that have any undergraduate school debt. Probably would not be a shortened path to forgiveness for borrowers with whose original balances were low. Borrowers would have to pay for 20 or 25 years to qualify for income-driven repayment forgiveness. But if they left other rules that are part of the SAVE regulation intact, like people not losing retroactive credit towards forgiveness when consolidating, that would be a big plus. If this were the outcome, say the SAVE plan is probably still going to be the cheapest option for most borrowers, but it won't be quite as cheap as it was originally meant to be. So navigating the current environment, as I said, the litigation has introduced a lot of uncertainty into the system. You want to err on the side of caution at this point. So particularly when it comes to doing consolidations are a little bit tricky. You can do them, you can submit paper applications, but there are a number of factors that need to be taken into consideration. So you want to reach out for some advice before you embark upon a consolidation in this environment. Staying informed, I've linked when by the way, everybody that registered for this presentation and webinar is going to get a copy of this deck electronically, and you'll have these links in the deck. So there were 2 different Department of Education and Federal Student Aid websites that are giving updates on the court litigation. You can also subscribe to the EdCap newsletter. So we tend to only put those newsletters out when there's something really important that needs to be conveyed to everybody. So you can just click on that link, put your email in, and you'll be getting those newsletters when we write them. Okay, I'm going to go on to actually, let me stop there for a minute, and Jenna, and see if there are any questions that we want to try to clarify at this point.
There are actually no questions so far.
Oh, okay. In that case, I'm gonna move right along and start talking about.
Sorry, Nancy, one actually just came in.
Okay.
So let me bring it up. This person lives in New Jersey, but works in New York City, has worked for a nonprofit for 3 years. They're wondering if they qualify for any type of loan forgiveness. In other words, is it partial or is it all or nothing?
I'm sorry. Who did you say?
Public.
Oh, so public service loan forgiveness is that's. You don't get partial loan forgiveness with public service loan forgiveness. With public service loan forgiveness, and we're going to talk a little bit more about that, you get no forgiveness until you earn you complete the requirements of the program, which is you have to pay into it for 10 years. At that point, there's no limit to what your forgiveness would be. Whatever the balance is on your loans at the time that you meet the requirements would be forgiven. So it's kind of all or nothing. Like you don't get any forgiveness while you're earning credit, but once you get the credit, you get complete forgiveness. Okay. So I'm going to move along now, and we're going to talk about repayment plans. So no discussion about student loans is ever going to not include ultimately a discussion about repayment plans, because repayment plans are your vehicles by which you are going to get rid of your debt. And within the federal student loan system, there are basically two ways to pay back your debt. There are traditional repayment plans where the payments are based on the size of the debt, the interest and the interest rate, and a predetermined payback period. So that's going to be like paying back. The fixed versions of these plans are going to be like paying back any type of regular consumer debt. It's like paying back a mortgage or an auto loan. You make one monthly payment over for whatever the term of the loan is, after which you pay the entire debt, including all the interest. The alternative to the traditional plan, if you can't afford the traditional plan, which a lot of people can't when they first go into repayment, is something called income-driven repayment, or IDR. Now, when I say income-driven or IDR, that's an umbrella term for 4 different plans. So I know that gets confusing for people, but that's what it is. The IDR plans often offer an affordable alternative to the traditional or standard plans, because in most cases those payments are based on your income, your family size, and your tax filing status. So in most cases, the payments in those plans really have nothing to do with the size of the debt or the interest rate that's on your loan. Now, some of the pros and cons for traditional plans. If you can afford the plans, the payments are more predictable. So it's going to be like a fixed payment, or they do come in graduated versions as well, where it starts out lower and increases every couple of years. In those plans, you're going to know what your payments are because they're not dependent on your income. It can, not always, but it can provide a shorter path to repayment, particularly if you're in a position to pay off the loans aggressively. There's no recertification or income verification, so they're very easy to administer. You just enroll in them and pay according to the schedule. And again, these are going to be best suited for people with high incomes relative to their debt. The downside about the traditional repayment plans is that sometimes the payments are just too expensive. And particularly, if you're coming out of school or in going into repayment on your loans for the first time, you have a relatively high debt balance, and either you don't have the job that you hope to have one day, or you just don't have a job at all, you're not going to be able to afford the payments in those standard plans. There's also limited ways to adjust those payments once you're in one of those plans. Or if you're going to stay within the traditional plan system, there's just a limited flexibility in terms of adjusting for the payments. And you're not going to receive forgiveness if you are in these plans. You're not going to earn forgiveness in most of the plans, and you would not receive forgiveness if you were in these plans throughout the life of the loan. Plan names, just so you're familiar with it, if you ever see them, things like standard, extended, graduated, these are all versions of the traditional repayment plans. Income-driven repayment plans, the pros, obviously, they're going to be in those cases where you can't afford standard plans. Hopefully, there's going to be an income-driven repayment alternative that is affordable. These plans do offer loan forgiveness after 10 to 25 years, depending on which plan it is, or what kind of loans you've got. Sometimes the IDR plans are required for certain programs like IDR forgiveness or public service loan forgiveness, and they are going to be best suited for those people we talked about with the strategy section a little while ago. If you've got a high debt balance, low to moderate income, or if you're pursuing certain forgiveness programs, you're going to need to be in IDR. The drawbacks to IDR is that you do have to go through this annual recertification of income and family size and tax filing status, which can be an administrative, issue. Potential interest accumulation. So if your payment does not cover the interest on the loan, the unpaid interest in most of these plans is going to accumulate on your account, and your balance will grow. And that's how your balance is mushroom, even though you're making payments. It may take you longer to get rid of your debt in an IDR plan than it would in a traditional plan. Depends on the circumstance. And then the plan names, as it currently stands, is the SAVE plan, which is currently on hold. The predecessor to that plan, by the way, was revised pay-as-you-earn or payee. And then we've got pay-as-you-earn or payee, income-based repayment or IBR, income contingent repayment or ICR. And the menu of plan options is subject to change depending on what the outcome of the litigation is. In a nutshell, the IDR repayment plan options amidst this SAVE litigation. So if you're not currently enrolled in an income-driven repayment plan, you can submit a paper application. You would do that through your servicer. You would need to do that and make sure that you provide proof of income when you do that. Right now, the Department of Education would accept applications for the SAVE plan or for income-based repayment or IBR. And for ICR if you are a Parent Plus borrower who has consolidated your loans. The payee plan is really, they're not enrolling new borrowers in the payee plan right now unless you were already enrolled in the plan or you applied before July 18th or in a very short window within August. Borrowers with loans for their own education have the options to choose between SAVE or income-based repayment. Borrowers with Parent Plus loans are limited to selecting the income contingent repayment plan amongst the IDR plans. They must consolidate their loans first before they do that. And then ICR is no longer available to non-Parent Plus borrowers who were not already enrolled starting July 1st. So it's a little bit complicated right now. If you're not sure what your options are after all this, you can reach out to us and we'll go through your individual set of circumstances. But the key thing is that the online applications are not available. Paper applications could be submitted. Right now, they're not processing anything, which means that it's going to take a long time to get these things processed. So some of the benefits of the SAVE plan, and of course, whether this plan is available after the litigation is a question mark, but these are the features of the SAVE plan that really made it so attractive to most student loan borrowers. First of all, the interest subsidies. I was mentioning a minute ago that if your payment doesn't cover the interest, which in a lot of cases, if you have a large loan balance and a moderate income, it won't. In the SAVE plan, that unpaid interest does not accrue to your account. So it doesn't mean that you necessarily are paying your debt down, but it also means that the balance won't go up, which I think is something that's very disconcerting to a lot of borrowers. The forgiveness component in the SAVE plan, there was a shortened path to forgiveness. If your original loan balances were $12,000 or less, you could receive forgiveness in 10 years. And then for every additional $1,000 of original balance it would take you an additional year to get your loans forgiven, and up to the 20 or 25-year maximum. Spousal income. So if you're married in the SAVE plan, your spouse's income is excluded if you file your taxes separately for the purposes of calculating your payment. So in the predecessor to SAVE, under the revised pay-as-you-earn plan, if you were married, your spouse's income was considered in the repayment calculation regardless of how you filed taxes. The new SAVE plan puts this in line with all the other repayment plans. So in all the other repayment plans, if you file your taxes separately and you're married, the payment is based on your income alone. Consolidation options. So borrowers with non-direct loans like FFELP, Perkins, and HEAL loans can consolidate to access the SAVE plan. So you have to have direct loans in order to access SAVE. The one exception here is direct Parent Plus loans. So direct Parent Plus loans are not eligible for any of the income-driven repayment plans, but if they are consolidated, they would have access to ICR. They don't have access to the SAVE plan. Parent Plus loans is a whole other kind of kettle of fish, and have some more complex issues facing them. So if you have Parent Plus loans and you have questions about those, you might want to reach out for a one-on-one consultation to give you some thoughts and strategies about how you may manage that. And one quick caveat for anybody considering consolidation of Parent Plus loans, you want to be very careful about consolidating your Parent Plus loans with any loans that you may have taken out for yourself, because you may subject that entire consolidated balance to just ICR as your only IDR option after that. So reach out if you're thinking about consolidating Parent Plus loans. The Onramp. So the Onramp was offered and announced by the Department of Education when they announced last year that the payment pause was ending, and that payments were going to resume in October of 2023. They also initiated something called the Onramp. The Onramp is essentially a grace period during which, if you skip payments, you won't essentially be subject to any serious financial repercussions. So basically what happens during the on-ramp, if you miss payments, and this, by the way, applies to borrowers who were eligible for the payment pause. So if you have, it's going to apply to most borrowers. So most borrowers with direct loans or Department of Education held FFELP loans are going to be eligible for this. If you had the types of loans that were not eligible for the payment pause, this does not apply to you. But for everybody else, if you skip payments during the on-ramp period, no late fees are going to be applied to your accounts. Those missed payments are not being reported to the credit agencies, and you will be at no risk of default, even if you skip payments through that entire period. The on-ramp option is scheduled to end at the end of this month. There is a chance that the Department of Education will extend this, but we haven't heard anything official as of yet. So as of right now, that on-ramp ends at the end of September. If you have not made arrangements to get into an affordable repayment plan and you've been using the on-ramp to skip those payments, you want to start making those arrangements right now, because come October, all these things that weren't happening over the last year may start to happen. So late fees will be applied. Missed payments generally are not reported to the credit agencies for 90 days. So after 3 months, your missed payments would be reported. And default is something that is potentially you are at risk for if you miss 270 days or 9 months worth of payments. So you still have a lot of time to figure that out. And then missed payments, by the way, during the on-ramp did not count towards forgiveness in most cases. Okay, Jenna, I'm going to stop there before I go on to cancellation and discharge, see if there were any questions.
Yeah, an interesting question came through, which was there's a borrower whose part of their loans are in the ICR plan and the other part are in the SAVE plan. So they're in the ones in ICR are in repayment, the ones in SAVE are in the SAVE forbearance. I'm assuming that payments made in the ICR plan currently count toward PSLF. I'm wondering how, and maybe we don't know this, but how that would jive with the portion of the loans that are in the SAVE forbearance.
So the loan, remember, forgiveness credit is given on a loan by loan basis. So for the loans that you're making the ICR payments on, you should be earning credit towards forgiveness. But you've got a separate set of loans that are in this SAVE forbearance. I'm assuming those are loans for for yourself that were actually eligible for the SAVE plan. Unfortunately, because that SAVE forbearance is not eligible for forgiveness, you will not be earning forgiveness credit on those loans right now. So you're gonna have two different payment counts, essentially, qualifying payment counts once you get the ultimate qualifying payment count. And we're going to talk a little bit more about potentially strategies for dealing with people who may be very close to public service loan forgiveness, that might want to try to get credit during this period where you can't get credit. It's a little bit complicated, but we'll talk about that. But yes, you are going to have like differing qualifying payment counts on those loans right now.
Okay, great, thank you.
Okay. So we're going to talk, Jenna, was there anything else or was that it?
That's it for now. Thank you.
So we're going to talk about the forgiveness programs that are some of the options that are out there, some of which we've already mentioned, others that we have not talked about that you may not be aware of or may be aware of. I'm going to start with income-driven repayment forgiveness, or IDRF. So up until the SAVE litigation, all of the income-driven repayment plans offered forgiveness if you made repayments in them for anywhere between 10 and 25 years. For most of the plans, you would have to pay into them for 20 or 25 years before you could get forgiveness. There's no employment requirement when it comes to income-driven repayment forgiveness. It's just simply you have to be in the plan. So if your loan is eligible for the repayment plan and you're in that plan and you're making those payments for 20 or 25 years, and you're making them according to the requirements of the program, you are earning credit towards income-driven repayment forgiveness. So this is going to be the default forgiveness program for people who have large debts, moderate incomes, but they don't necessarily have the kind of employment that might make them eligible for forgiveness programs like PSLF or teacher loan forgiveness, where you could get forgiveness faster than 20 or 25 years. The other key thing that you should know about IDR forgiveness is that after 2025, forgiven balances in IDR forgiveness may be taxable. They aren't currently. If you had your loans forgiven through IDR forgiveness through December 31st of 2025, they would not be taxable, but starting 2026, right now, as it stands now, they would be. The other big program that a lot of people know about and a lot of people participate in is public service loan forgiveness. So public service loan forgiveness forgives your balances after making 10 years of qualifying payments. So you need 120 qualifying monthly payments. You must have direct loans in order to get forgiveness in this plan. But non-direct loans, things like FFELP loans, Perkins loans, HEAL loans, those can be consolidated to make them eligible for PSLF. And you do have to meet employment requirements for PSLF. So with PSLF, you have to work an average of 30 hours per week for a nonprofit or a government employer in order to be eligible. And with PSLF, it's not about the job that you do, it's about your employer. Okay. So if you don't have to be a nurse, you don't have to be a teacher, you don't have to be a social worker in order to qualify for PSLF. You could have an administrative job, but if your employer qualifies and you work an average of 30 hours per week or more, then you're going to qualify for PSLF. Other aspects of PSLF that you should be aware of is that the payments do not have to be consecutive. They are cumulative, meaning that you can accumulate payments for 2 or 3 years in PSLF, then leave to maybe go to a for-profit organization, but come back 3 years later, you will not lose the payments that you accumulated. And then one of the best features of this plan, of course, is that forgiven balances are never subject to tax at the federal level in PSLF. Borrower Defense to Repayment, or BDR, that's a program that discharges your balances if you feel that you were defrauded by your school in some way, if they misrepresented certain facts about the school, like their graduation rates or job placement rates, or they offered to provide services that they ultimately didn't provide. That's a BDR claim. BDR claims are difficult. It's a complex application, 20 to 25 pages long. It can take years to actually get a decision. But if you feel that you qualify because your school kind of fits into that category, you can reach out for us and we can help you file that claim. I should mention that BDR is not for things like you just didn't like the curriculum or you didn't like the professors, or God forbid you were, the victim of an assault or harassment on campus. This is about trying to prove that the school deliberately defrauded you in some way. Total and permanent disability, this is kind of what it sounds like. This is for borrowers who have any kind of mental or physical disability that would prevent them from earning a livable wage. So this is actually, if you qualify for it, and you don't always necessarily want to qualify for something like this, but particularly in the case of older borrowers, or if you know some older borrowers, if you qualify for it, it can be a relatively speedy way to get your federal student debt forgiven. You file the forms, and generally you get some kind of a decision within 2 to 3 months. So it can be a relatively quick and easy way to get rid of your loans, as long as you meet the criteria. All right, I want to go into right now some guidance for people who are pursuing PSLF in this environment, to try to see if there's a way to kind of work the options that are available to you to get some additional credit for public service loan forgiveness. So first of all, I want to make very clear that the legal challenges are not targeting the PSLF program itself. So at the end of the day, when everything is resolved, the PSLF program and the program rules will remain intact. But the litigation does affect IDR plans, of these income-driven repayment plans, that are required that people enroll in, and they're required for people to make their payments in to earn credit towards public service loan forgiveness. So it is impacting PSLF in that way. So for borrowers who are in the Save Forbearance right now, remember that Save Forbearance at this point is not eligible for any kind of forgiveness credit, whether it's IDR forgiveness or PSLF. But if you're close to that 120 qualifying payments, so maybe you've already got a qualifying payment count of 115, 116, 117 qualifying payments, and you know that like within 2 or 3 months, you're going to hit 120, there may be some things that you can do. There's something called the PSLF buyback. This is a new feature of the PSLF program that allows you to purchase months that you spent in a forbearance or deferment that were not eligible for forgiveness. And there's a whole process to do this. I provided the link here to the buyback page. You have to file something called a reconsideration request that would allow you to maybe get credit. Now, there are some restrictions on when you can do this. So you must have 120 months of qualifying employment on record to use this option. So that means if you have, you may need to file updated employment certification forms, so those PSLF certification and application forms. If you haven't filed them, you need to maybe update that before you can use the PSLF buyback option. And the number of months that you're buying back must get you to 120 qualifying payments. So this option really is for people that are within striking distance of 120 qualifying payments. If you're a year, 2 years, 3 years, 4 years away from PSLF, this is not something that you can avail yourself of right now. You might be able to do it down the line, but not right now. You also cannot buy back months prior to a consolidation. So if you just consolidated your loans and you want to buy back, if your consolidation took effect this month and you wanted to buy back, a period of forbearance in August, you wouldn't be able to do it. So if you are in striking distance, you could try the PSLF buyback. I will say that it's a new feature. We don't know how well it's working. We don't know how long it takes to get an answer, but you can go ahead and there's really no downside in trying. The other option potentially is, if you are within 1 to 2 months of reaching 120 qualifying payments, is file an application to switch your IDR plan, and then request a processing forbearance. In theory, processing forbearances should be eligible for forgiveness for up to 2 months. The big question mark, though, is that we're not 100% sure that the processing forbearances that they're issuing now are offering that forgiveness. So you can try to do this, but I cannot guarantee you that it's going to work. If you choose to do this, you're going to have to file the IDR application manually using a PDF. So you want to, once you do that, you want to upload the form to your servicer account, but don't forget to provide some kind of proof of income. The other potential way, and this is for people who may be eligible, for people who are very, very close to PSLF, who just want to make their last few payments and get it done with, is if you can afford the standard 10-year fixed plan, and if you're eligible for it, some payments in the standard 10-year fixed plan will count towards PSLF. You can't remain in that plan for the entire life of the loan and get PSLF because that's a 10-year plan that pays off your entire debt. But if that's something that you are eligible for and that you can afford those payments, you can switch. That's something you can do now. You can call your servicer, switch to that plan, start making those payments, and those payments will be eligible for public service loan forgiveness. Now, a note to anybody that's got direct consolidation loans, most of you will probably not have access to the standard 10-year fixed plan. The repayment periods for consolidation loans are based on your loan balances, and unless your balance is less than $7,500, you're going to be in a more you're going to only have access to extended versions of these standard year fixed plans, which will not qualify towards PSLF. So, but if you happen to have unconsolidated loans and you can afford the payments, this might be an option. I would suggest you contact your servicer, find out what the payment in that plan is first, before you go and do this switch. And if you can afford it, go ahead and do the switch. For any borrower who's pursuing PSLF and any of the other income-driven repayment plans, like that borrower who just mentioned that they were in ICR, or if you're in PayE or IBR, just continue making those payments in those plans. Those plans are not on hold right now. If you're already enrolled in them, continue making those payments. If you're asked to recertify the IDR plan, submit a paper application to your servicer. I will also say that we are anticipating at some point that the Department of Education may push back the IDR recertification deadlines because they're just not processing the applications right now. But again, we haven't heard anything official as of right now. I think overall the message is, if you're in the SAVE forbearance and you're pursuing public service loan forgiveness, it's probably just going to take longer to actually get your forgiveness if you're close to it at this point. So patience is the key. Once you think you have the 120 qualifying payments, if you're not already in a forbearance, you can request a forbearance while you're waiting for the official count. And again, this is really confusing. We understand that at this point. So if you're in one of these situations, please reach out to us for a one-on-one individual consultation. You can, however, continue to file the PSLF certification forms. So the PSLF certification forms are the forms that verify that you've met the employment requirements for public service loan forgiveness. So these are separate from the income-driven repayment plan forms that enroll you in a repayment plan and determine how much you have to pay on a monthly basis. This is the PSLF certification forms really have nothing to do with your payments. It's all about verifying that you've met the employment requirements for the PSLF program. So you have to have one form on file for every qualifying employer that you've had since October 1st of 2007 or later if your loans were dispersed after that date. These forms should be filed annually or whenever you change qualifying employers to a different job. And the best way to do this right now is to use the PSLF help tool. This is something that you can use from your federal student aid account at studentaid.gov. There are different ways to file this form, but the most efficient way is to use the PSLF help tool to generate the form and then request an electronic signature from your employer if that's at all possible. That we understand that forms filed in this manner are getting processed and are getting processed in a relatively timely way. Although the forms may be processed, may take a few more months for them to update your qualifying payment count, but they are being processed. Anybody submitting forms with manual signatures, whether it's generated through the help tool or just a PDF version, it's going to take a lot longer for those forms to get processed. Sometimes you have no choice but to file the forms that way, but if you can file it using the electronic signature, that's the way you want to go. And then I've got links here to studentaid.gov for instructions on how to do this. Again, you're going to have to expect processing delays. And remember that starting July of this year, the PSLF qualifying payment count is now managed directly by the Department of Education, and your tracker, if for those of you that may have been doing this through Mohila, the trackers are no longer on your Mohila website. They will be on your studentaid.gov or FSA accounts. When you log into your studentaid.gov account, when you go to the menu, which is your name at the right-hand side, you want to go to dashboards and then scroll down to quick links on the right-hand side, and you'll be able to, oh, I have a picture of it right here. You'll be able to see your PSLF tracker where it says track your PSLF progress. By the way, you'll only have a tracker if you filed and the PSLF certification forms and they've been processed. And then that screenshot on the right is an example of what the tracker looks like. So it's going to tell you things like how many qualifying payments you have, how many payments you have remaining. And then if you click into the summaries, it's going to give you even more detail about your qualifying payment count. Quick word about the student debt relief plan. You might have heard that the Biden administration announced what they're calling debt relief plan B. This is, if you remember, the plan to try to eliminate up to $20,000 in debt for most borrowers in 2022 that ultimately got rejected by the Supreme Court earlier this year. This is kind of a follow-on from, this is the sort of the next step, the next version. It's a more targeted plan. I'm not going to go through it in detail. You can read this once you get your deck, but it gives the option for borrowers to get partial or full relief based on certain circumstances. If it were fully implemented, actually quite a few people would get some kind of relief, probably up to 20 or 25 million people, which is a lot. But there's already been a lawsuit that's filed to stop this, so it's on hold for now. We'll have to see where it goes from here. The IDR account adjustment, you may be aware of this. The IDR account adjustment was a one-time account revision that allows borrowers to qualify for qualifying payment credit towards PSLF and income-driven repayment forgiveness based on a relaxed set of rules that I'm not going to read right now. The deadline for making yourself eligible for these benefits was June 30th. But basically, if you have direct loans or if you have FFELP loans that are held by the Department of Education, you're going to be automatically eligible for this benefit. The Department of Education plans to notify borrowers later this year of how many qualifying payment counts they have towards forgiveness through the IDR account adjustment. And hopefully they'll provide a tracker on your federal student aid account that shows you how many qualifying payments you have towards IDR forgiveness. And then those qualifying payments could be turned into PSLF payments if you're by filing the PSLF certification forms, as long as you have direct loans. Fresh Start was a program, or is a program, for borrowers that are in default that will allow you to bring your loans out of default and repair credit. It's right now the quickest and easiest way to get out of default. It's the vast majority of defaulted federal student debt is going to be eligible for this. You just need to either file the FAFSA or call your servicer, which in most cases is going to be Default Resolution Group, and request that they initiate Fresh Start. Your loans will be transferred to a non-default servicer. And then you'll either enroll in a repayment plan or enroll in school and be placed in an in-school deferment, at which point any credit damage would be repaired on your credit reports. But you have to opt into this, and this program will end on September 30th. So very little chance that this is going to be extended. So if you're defaulted and you haven't done this, you want to do this literally in the next week. It's the quickest and cheapest way to get out of default right now. And then finally, private loans. Everything that we talked about up till now really only pertains to federal debt. But for those of you that have private loans or that are thinking about getting private loans are a different animal. They're offered by banks, credit unions, private institutions. The Department of Education doesn't really have the authority to dictate what people do, what lenders do in the private student loan space. They generally don't offer payments that are based on income or any kind of forgiveness programs, maybe the occasional disability option, but even that is rare and difficult to obtain. Private loans do require credit checks, and most student borrowers are going to need a cosigner, which is usually a parent, but it could be anybody that's willing to sign. Just remember that if you're thinking about doing this or you're thinking about co-signing on anybody's loans, co-signers are 100% liable for the loan if the primary borrower can't pay. And it can be very, very difficult to get a co-signer released. So the interest rates on private loans are determined by prevailing market conditions and by the credit worthiness of the people who are applying. The one, I guess, slight plus for private loans is that they are subject to a statute of limitations, meaning there's a date after which they cannot sue you in court for this debt, whereas with federal debt, there is no statute of limitations. The government can come after you for the rest of your life. But the basic message with private loans is that it should be the last resort for funding your education. And we would argue that you should really try to avoid these at all costs if you can. But of course, for those of you that may have private debt, and we know that there's lots of people that do, you can reach out to us and we can see if there's anything that we can do to help you come up with a strategy for payment. And that's it for the presentation. This is our contact information. So like I said, if you require a one-on-one consultation after this, you're more than welcome to reach out to us and schedule something. And at that, I'm going to open it up, Jenna, to see if there are any final questions that we need to address.
I think we were actually able to address everything.
Okay, I do see somebody with a hand with a raised hand. Quinn, not sure if you want to unmute yourself and ask a question. Okay, maybe not. Okay, well, great. If that's it, I'm gonna wrap it up for today, and thank you once again for joining us. And I know that this is it's even without the litigation, this is always a complex topic, and so right now it's particularly complex. So if you do have additional questions and need help, please feel free to reach out to us. And everybody, by the way, will get a copy of the deck and the recording. So thank you, everyone. Jenna, you're muted.
Oh, I'm so sorry. There seems to be one last question that just came in, if
Okay.
that's okay.
Sure.
Is there a deadline for the PSLF buyback program?
No, there's no deadline for that program. It's just that you have to kind of meet the requirements in order for it to be applicable. And I will reiterate that I don't know how long it might take to actually get an answer through the PSLF buyback.
Thank you.
Okay, thanks everyone.